So you've had your house for a while and you have disposable income and you're debating on if you should pay off your house early. If you're thinking about that, this video is for you. We're going to dive into some things to think about, things you make sure you have in order, and then is it the right plan for you? Hi, Ray Williams, Mortgage Maestro Group. My goal is to create a channel of videos you can go to, learn from, take away from. Here we go. Should you pay off your house early? There's not one right path for everybody. For some, it may be the right plan. For others, investing the money may actually yield better results over time. You got to think about discipline. Are you disciplined enough to stick to the plan longer term? Both are viable options, whether it's to invest or put it towards the mortgage. Some people would say, go extreme, stay home, don't leave the house, eat ramen. Is that the path you want? One school thought, start with your personal debt. Eradicate everything except for your mortgage and then move forward. An emergency fund, super important, guys. If you're thinking about paying off your house early and you don't have an emergency fund, stop. Depending on the stability of your job, the type of job you have, the volatility, the pay increases that you project, 3 to 6 months of life expenses, meaning go to your budget, go to your credit cards, go to your checking account. What do you spend collectively every month? Add it up, take a 90-day running average. You either need 3 months of that or 6 months. If you're self-employed like me, 12 months, because what happens if business shifts and you're self-employed? You can't get the money back out of the equity of your home without borrowing against it. So make sure all your other ducks are in a row first, guys. There is a benefit to paying off the house faster. It's forced savings if you think about it, right? You're reducing your payment once the house is paid off. You're saving money by paying the balance down. Here's an example though. If you send one extra payment a year, the math is about 5.5 years is how much time you'll knock off the life of that loan just with that one extra payment. So even a little bit can go a long way for your financial future. There's another way to manufacture money as well. Review your bank statements for the last 90 days. We all have holes in the bucket. What is going on there? Are there subscriptions you don't need that you can cancel? Are you spending too much money on coffee every day, lunches out? If these things are all in order, you're in great shape. But if they're not, shore up the boat first and then move forward. Here's another one. Recently, we've gone through this rash of inflation for the last handful of years. There is a principle about the psychology of money that I've talked about before, which is what is your relationship now with money compared to what it was before inflation went through the roof? And if it's changed, it might take some time for you to recalibrate your considerations about should you pay off your house early. Another thing to think about, have you budgeted for increased payments? You might be saying, Ray, what the fuck are you talking about? I got a fixed rate mortgage. Sure. Your taxes are not fixed. Your homeowner's insurance is not fixed. If you have HOAs, it's not fixed. You could get an escrow shortage from taxes and insurance. If that happens, do you have a ceiling in there for your budget to allow for this to be absorbed? Now, I'm going to give you 4 things to consider when you think about paying your house off early so that you can make the right decision for you and your family's financial future. Number 1, how long are you going to be in the house? Meaning, how long have you already been there? How long will you be there? The odds are for most people, the loan will not be paid off by the homeowner, rather the person that buys the house from them. So if you're not going to be there a long time, it might be more advisable to put that money into the financial markets and invest the money rather than paying the note down. Number 2, what is your current interest rate? If you're one of the people who have the 2s and 3s, then likely investing the money is going to yield you a higher return than the interest that you're paying on that home loan. Number 3, set up your retirement vehicles. Target the most possible. Of course, maximize that 401k and target 10 to 15% of your income to accelerate your wealth building, because you can build wealth outside of just paying off the home loan for sure. And you can create residual income that way too. Do you believe in their markets? Do you believe in the historical performance of the S&P or real estate? Those might be investment tools that you look to outside of paying off your house faster. Do you have the stomach for when the financial market turns? This might change your philosophy of dumping a bunch of money into the financial markets, because if the market turns, will you be able to mentally absorb that change? And honestly, set aside your effort fund. Life is short, maybe 10% for fun of your pay so that you can live going through this process as well. Number 4, Ramsey. He said, Don't buy another house until your first house is paid off. Now, I can't say what's right for you, but I can say this. They have this philosophy of the 15% plan that after 20 years, if you invest 15% of your income, you can reach millionaire status. That's valid, and that's a great discipline to pursue. Is it right for you, though? Only you can answer that question. Ramsey stated in his study of 10,000 millionaires to stay away from debt, that the first 1 to 2 million in net worth happens from 401k and paid off housing. So that's their philosophy. Maximize 401k, pay off the house. That's what those people did, those 10,000 millionaires that they followed. Here's a case study from someone who did not pay off their house before investing, and they chose investing in real estate. This was accomplished in 15 years, 2 real estate acquisitions. Property 1, acquired in 2006 for $150,000, currently worth north of $700,000, and it's mortgage free because tenants paid it off. Dave's advice would have yielded that that person did not buy the rental because of the fact that they shouldn't have done it because their primary residence was not paid off. Number 2 acquisition, $700,000, again, while their primary residence was not paid off, currently worth north of $2 million, bringing in $200,000 of revenue as a short-term rental. So again, with Dave's advice, this would not have occurred. I'm not saying you should or shouldn't do these things. I'm just saying we all know ourselves. We know our intuitions. We know our risk tolerances. We know that if we're meant to be landlords or not landlords. We know if we have the stomach for the financial markets. So it can fit the right person to pay off the house first. But what is your intuition telling you? At the end of the day, both philosophies can be successful. What's your relationship with money? What are your disciplines? Where does real estate fall into your investment portfolio or philosophies? These are all great questions to consider as you progress through this evolution. Drop your comments below, or your questions or your thoughts and your feelings. You may have opposing ones. Let's have a conversation. In the meantime, watch another video by us about building wealth through real estate. Again, Ray Williams, Mortgage Maestro. If you'd like to chat, calendly.com/Mortgage Maestro. We look forward to sharing more educational content with you. We'll talk to you soon.